We are going to feature this 1250 put that made money on the intraday level only yesterday, and they're treated intraday level for one reason. Today we have a mark open up gap versus a market open down gap yesterday. So when these things went and made their highs, they ended up closing at 38, but the high was 53 and the low was 45.60 and the last print was 45.80, marked up 780. That markup goes away today. Brian Plain, set me alarms on this one here at 35 and a half. If they open the market lower than that, then I want to get down to that 32 32, let's just call it 3290 alarm, and 3290 alarm also catching from the print. So let's mark it down 15, so plus $7.80. So let me know, put me one limit order out there at $30.25, or make it 30.60, so that way if it comes down through there, we'll see how they mark the put option. Had 7,800 contracts traded yesterday, and from day to day, the put pays, but from day to day, the call pays. They both pay, and that's the remarkable coverage of the S&P put option in the price action. The 1217 call yesterday had a closing price, and these were the same very calls that we had traded, because we did. And the thing about it is, we sold at the high of those calls because we had MMTs in that. If the markets were to break higher and get up to that 1300 or right below that 1300 handle at resistance, then this could possibly have some upside move. It will be that they were marked down $8.60. Unlike the other one, the put option is at the 1217 contract of there's also a 1250 contract for 1217 here as well, and it's a $19.80 by 2240. Okay, and I can tell you on this particular put that's the December contract. Okay, so this particular contract will go into your market minders, and once you have them in there, you will have that contract to look at. This was marked down 860, and this was marked up 810 on that 1250 put for the December 1217 contract. Now, if you want to get a little bit more intrinsic value about the one that we were talking about what if they're going to sell into the, but remember, it's December 13th, 2001. And here are the contracts here, the 1250 put called 121 2000 12. How about that? They marked up, closing markup at 780. That's the one that we're going to be bidding lower on. And we're going to use a game plan in our entries within the volatility band. Yes, this is it right here. And now I'm going to come over here and I'm going to show you exactly how the January put has traded. And these are the lower end of the markets. And remember, this is when when markets are selling down. This has put in a daily bottom support level here in the contracts and the pricing controls. And yesterday you went up in value back up to 53. But the prior day, look, the prior day on 12/9, the low was 38, but the open was 48.80, and the high was 48.80, and the low was 38, and the close was 38. So they marked them down and then they marked them back up. And that's on that put. So they're intraday entries and exits with profits only. They're not to hold overnight. Because if you do, um, here's a perfect example on an intraday level here on 12.8. The low, they open at 45.80. 55.45 was the high, and the low was 43.70, and that close was 52.50. That's this bar right here. And this is that put side. That's that 12.50 put side. Now, and it's a December contract, and that's the one that we were bidding on because it's been in this daily movement. Today they're going to mark that down to this. We're going to see if they mark them down below this major support level. Just remember, the lows were 36.70 here, and we did get hit in some accounts at 38, sold them in the upticks, but and that's up in the moves, and then intraday only. So there are days when the puts are going down in their value that the call side that is tradable on the call side, where that S&P dropped down to. Remember, the S&P gave up a lot of points yesterday. So if you're trading that call side, you could look at this. This is a nice one right here. It's a 12:30 December call. All right, the 5-day cycle, 1, 2, 3, 4, 5. Hey, the high up here was 45.45. They're still down here in a wholesale area. There is upside for the 12:30 call to be traded. That 12:30 call is about where the S&P had its good support areas yesterday. But you can see how the call side got marked down here. And these are good transactions. And the ranges, well, yesterday's range was on the open 21.95. That was the high, and then it ticked. Then look what happened. They came all the way down to 13.60, but they closed at 16.50, right off of $3 off of their lows. So any one of those lower entries on this S&P is well worth trading intraday. And what I will do is I will make sure that this bid and ask stays here and how they mark up this side of the chain of the S&P. And we're going to be very, very, very thoughtful of just the very opposite sides with some of these put options. And we know that the 12.50 call, this is where we started that move down yesterday, and we're going to want that one here. And and all of these right here are the December contracts now. Okay? And we have an FOMC meeting. I will go over and the entries here, depending, because we have a gap open up market right now. Key feature that we have here is a December Emini S&P 500 daily chart, and this is moving right now. And we are happy to present it to you because this is where you made your support level at this trend line in this market here. And we started covering this the last few days. And we're going to measure the upside volatility and set alarms here on the E-mini futures, and those are 1253.26. Okay? That's going to be the 200-day simple moving average, right where the pointer is and right to there. That upside 10-day moving average that it broke down here to these major support levels yesterday, that downside there, that low yesterday was 1233. Okay? And part of what we're looking at over here is the markdown in the 1230 call for today. And that was a 1230 call based on where the futures made their lows here and how they took that from 35.50, marked the gap open down yesterday on 1212 in the morning. See, that's the close. That's yesterday's high. Look at that markdown. So part of that markdown is built in that premium, hijacking that premium. And so that call got taken to the woodshed. So there is a premium trade today based on the intraday movement in these futures because they're in a gap open up mode right now. 10-day simple moving average to be aware of is going to be 1248.07. That's the blue line. That's that support line. Remember that you're still doing what? You're still printing a short tape. Today's gap open tape is what we'll be going over in the next segment as we go into the opening bell. It's 5:58. We have an FOMC meeting. These bars are still doing what? They need to gap outside of here. That's going to put you a trend line right there. And you're going to have to consolidate 1250 here. The pullbacks would be viable on the call side, and that very same put side would go down in value. So we're going to see, if we, right here is where we're at. So that's your amount of your pre-market gap up. And the contracts here, once again, you're looking at this one here. Okay? You're looking at that 1230 call because that's at support level here in the futures market. And if we can close up above here, well, then the dips are viable, like these daily wicks. Those are how you get the wholesale increase and sell back to the public. We will also be watching the put side of things, meaning that this 1250 put that was making all the money yesterday, here it is. This is that 1250 put for December now. Okay? And you're going to want to monitor this, MMTs. Here are your price ranges. All right? And we're down from day to day. You can see the put, and I just showed you the call based on pre-market open gaps. And how do I use that to my advantage? And when I look at the first hour of the futures market on the S&P, I'm going to show you what the low and what the highs and what the highs and what the lows were for only one reason, so that you can see where the public sentiment is. Here is a 60-minute chart, again, of the futures market. And we viewed it. It's really important that understanding this market is going to help you make your transaction on your call side market or your put side market. Okay? And that's where the coin's going to be, because this will be a guide with weakness and strength. And you can clearly see right now where the highs were. And today's date is 12/13. And the time is 6:01 a.m. Pacific Standard Time. You've had one full, complete transaction mode for an hour in this E-mini S&P 500 contract, December 11th. December meaning 2011 right here. Okay, and you can see here that right now you're descending in value. Meaning that you're not going up in value. Okay? And I'm going to see if I get, here's that call option right here now. Here's the chart on that call option. However, and this is on a 3-minute chart for the entries on that today, we're going to look and see exactly how these futures are doing what they're doing. Here's a trend line that I had on them. And I drew that trend line the other day. And this is a 3-minute chart of that E-mini December 2011 E-mini futures contract. You can see a reversal. But then you can see that retail sales have come out this morning, and you have a FOMC meeting, and it's nice to know where your futures market has started for that opening bell tape in 28 minutes. I'm going to conclude the 3-minute futures here on the S&P 500 and that you have a markup. S&P futures change up 830. Dow Jones are up 68 handles, and Nasdaq futures are up 1750. All right? So that means the gap open up market is going to have a transaction mode to it. And until you close up above this trend line on this 3-minute chart, then that means that that call option is going to be high risk, because you've got to hold this support level here, and you've got to bounce, and you've got to watch these futures going in that direction, and they got to close up above that trend line here. I drew these trend lines yesterday for you MMTs. Now let's take a look at that trend line again, and this is what's been happening. All right, so you've had your short days and your long days, but right now here you can see where that high is. Remember that the S&P 500 60-minute is consolidating here, and when we open in the cash market, we're going to validate that first 15-minute price bar. Does it hold above the initial 15-minute bar and test support level and start to go higher where we could buy and sell? We can. If we cannot handle that opening bell, it's better to stay out or put the orders down, and the limit orders 3 teenies up to sell short. Make sure you have a half a teeny stop. The futures are strong. Another thing I would like to show you is, and we'll do it separately, but here are the futures on the Emini 100. That's Google, Apple's, and all your other stocks that are gapping up right now. Okay? So we're right here, up here at these tops. So we're right there, and we're ascending. We've got strength. This is going to be a carry. This will open up in the opening bell in 26 minutes in the cash markets when they open up. This is pre-market futures, how to interpretate pre-market futures, how to understand the upper resistance limit in orders at 3 teenies with the half teeny stop clearly, because that's the way the market is gapping. We are in a range. On the opening bell, you have to program the trade to that, what the half teeny stop, what the 5 teeny. If it's strong, it'll be at 85% and higher. Pre-market update, as far as futures go, E-mini futures right before you on a 3-minute level.